Welcome back to the Onward Shift Podcast. Thank you so much for tuning in. And today we have an awesome guest with us, Rachel. Rachel, hey, how are you? How are you doing?
I'm good, thank you. Yeah, how are you?
Yeah, I can't complain. Sun's out. Had a couple of days off on the weekend. Feeling a bit confused as it's a Monday morning, but excited that me and you are about to have this awesome chat. So yeah, can't complain. I can't complain. How about yourself? How's your weekend?
Yeah, good weekend. Just did a bit of gardening, Mother's Day. So got spoiled a little bit, spending time with the children. But yeah, so it's been nice.
Amazing. So Rachel, could you tell us a little bit about who you are, Money First Aiders, and your whole vision and what you're trying to improve?
Yeah, definitely. So I'm Rachel, co-founder of Money First Aid. And our core offering is an online training course for individuals to become Money First Aiders so that they can support their colleagues who are experiencing financial challenges. It's a 2 to 3 hour online e-learning, self-paced, so people can work it around their shift patterns. And so employers tend to purchase a number of licenses for their colleagues. We also do other training courses, online e-learning, financial wellbeing awareness, improve your own personal financial wellbeing and things like that. And I, previous to this, was a financial advisor for 15 years as well. So always been in the financial services area.
So what made you shift from working for someone to, starting a whole new venture? What was it? What was the mindset shift there?
Yeah, well, I guess it's kind of been gradual because 5 years ago, I left my employed financial advisor role and I was probably going to set something up myself then, but actually ended up joining a fintech that was creating a financial wellbeing solution for the workplace.
Okay.
So I'd gone from advising, I guess, personal individuals, sort of private clients, to then moving into the kind of workplace wellbeing space through this organisation. And that ended at the beginning of last year. But as part of my role, we had built a financial coaching service that was delivered to employees and within the workplace. And we'd started to think about other options like training. And so myself and my co-founder Stacey both worked at that organisation. So then when that came to an end, we decided to take the plunge. So Money First Aid was established just under a year. Well, actually, it was our 1 year anniversary last week.
Oh, congratulations.
3 years. Actually, yeah, we made it. Wow. We've done a year. So we decided to take the plunge and move forward with an idea around Money First Aid training because we sort of saw that there was a gap in workplaces around financial wellbeing and employers knowing what to do to serve as many people as possible. But also there was a lot of growth around the mental wellbeing space and training in that area. Well, not just growth, it's more established now. Obviously, it's been over the past 15 years or so. And we felt that there was a space for that to happen with financial wellbeing as well, because to get people to chat about money and talk to each other and support each other, there's an education piece to be done really for people to feel confident and comfortable doing that. And that's why we came up with the idea of Money First Aid. And we also recognised that with certain training, we wanted it to be as accessible as possible for industries like the construction industry, like, retail, hospitality, etc., who have workforces that are operational, and it's difficult to kind of break that to let people go out for prolonged periods of time for in-person training and need to work around different shift patterns and all of those types of things. So we took that into account when we created the format. And so it's fully online, self-paced, so people can dip in and dip out and work it around their shift pattern, which helps the employer, but obviously helps the employee as well, so that we can have the biggest impact really and remove those types of barriers.
And, there's such an interesting thing you said there. It's like talking about money is so awkward. And I guess, what do you think? Why do you think the reason that is? Like, why do you think money is such an awkward conversation? It's such it's like we try and avoid it as much as we can. Why do you think that is?
I think a lot of it's probably culturally and the way that we're brought up. It's like, don't talk. We're always told not to talk about it, that it's sort of cringy if you said how much you earn. And actually, employers don't always encourage people to, or certainly in the past, there's more transparency happening now, but definitely in the past and still today, it's that don't tell people what salaries you're on because they don't want that comparison. Yeah, so I think that's why it's difficult to talk about money. And I think also there's this measurement, again, as a society, of how much money you've got equals how successful you are, and all of those things, which isn't true, but that's how we are, that's how we perceive it. So therefore, if you've got a challenge around your financial situation, that has like a bigger impact on you, where it's not just what, I've got a bit of an issue financially. It makes you feel a certain way as well. It makes you feel embarrassed. It makes you feel guilt, shame, etc. All of those things. So I think that plays a huge part in it as well.
Yeah, 100%. I couldn't agree more. And I think you're so right. I think this is embedded in us from such a young age of money. We don't talk about money. You don't ask how much people earn. You don't tell people how much you earn. You just kind of, if the conversation comes up, it's sort of like, let's shift the conversation somewhere else. Yeah, sway it, exactly. But it's so true. Like what you've just said has actually just made me think like, you're absolutely on the money. Hey, but because we don't, but because we don't talk about it, when we struggle with it, we have no one to go to. And I think money first aid is such a smart concept, because you're finally bringing something that needs attention to be like, you're kind of bringing it to people's attention and kind of going, yes, it's an awkward subject. Yes, it's a difficult subject. But if we provide education around it, more people will have the knowledge to at least, well, hopefully get themselves out of tricky spots. And I think, again, this is just a thought in my head, but I do think a lot of people are struggling financially at the moment. And there's not many solutions out there for people. Everything can be bought on a credit card, from even your fast food restaurants. Everything can be bought on Klarna or a pair of trainers or anything. And you just think, do people actually understand what that is, what a loan is, or, and how scary is it when you don't realize and you get hit with this huge bill, and a pair of trainers which you thought were going to cost you £100 now cost you £125 or £130. And I think that will be a really great topic to talk about in today's podcast, on the benefits of money and also the negatives, and kind of just an education piece around it.
Yeah, I think it is. Yeah, they've removed as much friction as possible from purchasing. So you can, especially if you save your card details on your phone, it is a one-click purchase experience. So all the barriers have been removed. And as you say, buy now, pay later is more popular and more readily available. And credit cards, if people have them. And then sometimes you feel a bit more removed from it. So when you've made the purchase, it's not really, you sort of forget that money is still owed, because you don't see it maybe on a daily basis like you would do with your current account if that was reducing in the balance or something like that. So it can create sort of bad behaviours that we have to consciously decide to kind of go against by not having Apple Pay links, or not having your card details saved, or doing things like waiting 24 hours before you make a purchase when you're thinking, oh, do I actually need this? And they all then have to be very conscious decisions, because that's kind of been taken out of the customer journey of buying a lot of things, and the ability to just buy things online and have that, and you receive it virtually instantly, don't you? It's next day. So you kind of get that instant gratification, which is what a lot of people thrive off and are looking for. But and then that just removes you from the kind of habits of saving and having that safety cushion, which actually takes a little bit longer, but has those same kind of benefits of making people feel really good about their situation.
Absolutely.
And about money. When people see the balances, there's so much research around, you have better sleep and you feel better, you feel more confident, you can have the flexibility to make other decisions because you've got this safety net and things like that when it comes to savings. But it doesn't, the habit, so it's about habit forming, isn't it? And that has to be a conscious decision that people make.
100%. I couldn't agree more. And again, something you touched on there is it is so easy and it's so accessible with your phone just to go tap, and that's it. You can make, I think back in the day the limit was like £100, but I think they've pushed that up as well now. So
it's much easier.
Yeah, and you can put your credit card on there. You just tapping away, and come to the end of the day, you're like, oh my God, what have I done? And I think that's
not physically having money anymore. That kind of removes it. Yeah, having children, you have to kind of talk about things like that as well, because they just go around tapping. It's like there is a balance behind it, and you do need to have a look at how much you're spending and where it's going, and build those kind of habits.
Absolutely. And I think, again, like something which is really, really important to understand is the saving side of it. And I couldn't agree with you more when you said that when you have a little bit of money just stacked up, saved up, it does make you feel better. It makes you feel so much more secure. And it gives you that if the boiler breaks down or if a fuse goes in the fuse board or whatever it is, you've got that little bit of money saved up so you can just get someone in to rectify things straight away. Recently, me and my partner, we have a car. It's an old car, but we needed to get the brake pads, the brake discs, the front suspension, the rear suspension, and a few other bits changed. And we thought to ourselves, we were like, oh my God, we basically put a very small amount of money away every single month just for the car, because we full well know when a car goes down, like it's so much, it's impossible around where I live to get around. So
you get so reliant on it, don't you? So when things like that, unexpected things happen, and I think we were talking as well about in the construction industry particularly as well, and around if people have like delayed payments or irregular income or gaps between projects, things like that, having that savings buffer means that all unexpected leave for whatever reason. So yes, big purchases, but also things like that happen, having a buffer means that whilst you're in a potentially stressful situation anyway, you don't also have that financial stress because you've prepared yourself for those unexpected times. Unexpected purchases, unexpected leave or anything like that, having a buffer available just makes a massive difference.
Absolutely. And I think that's a great topic to talk about, actually, because the construction industry, I don't know if you've heard of On the Tools, but they're basically a company supporting the construction industry, and they've recently brought out a white paper, and on that it states 65% of construction workers struggle with financial issues. And you think to yourself, that's a huge number. And working in the construction industry myself, I completely understand why that number's so high.
Yeah.
Delayed payments, huge problem. Companies coming in and undercutting, again, a huge problem. I think one thing we could focus on today would be how can contractors or anyone in the construction industry understand how to budget properly? Because sometimes you get a paycheck, let's say it's for £5,000. After you take away tax and NI and corporation tax, if you pay that and all the rest of it, you're not left with a considerable amount of money, but then you've got to pay rent or mortgage and food bills and etc. It's so hard to understand. We've got to put money away for that accident you may have at work, or, for me personally, when I had my first electrical business, it was my van broke down, and it cost £2,500 to repair. And you think, and you get stung with that, and you're like, damn, that's quite a hit.
Yeah.
So how can we provide education and budgeting so people do have those safety nets?
Yeah, there's loads of resources out there, and there are loads of support out there for people to help them to educate themselves and to find different ways of budgeting and planning ahead. But again, it can't be done for you. There's actually a lot of technology out there that can help support the process to make it as easy as possible, but you do need to make a conscious decision, and it's worthwhile doing it to say, what are my expenses? What do I need on a monthly basis that has to go out, and sort of prioritizing what those things are as well. So you might have a certain amount of expenses, say it's 2,000 expenses a month, whatever it may be. And then within that, what are my essentials that have to be paid and what's kind of fixed? And then what are the things that I want just to make my life, nicer and to enjoy them? And then also, how much can I try and budget to save? So thinking about those three categories when you are budgeting as well, because it isn't all about restricting yourself, isn't budgeting, which is what a lot of people think. Yeah. It's just about planning. And as you said, you get £5,000 and it can feel overwhelming, like I've got to plan this and this with it. It's breaking it down and saying, okay, well, and writing it down if that's what works for you, getting a spreadsheet if that's what works for you. Loads of apps out there, even people's bank apps have normally got budgeting on there. So if you are someone that uses your phone a lot, even playing around with that, you can normally categorize things on there. But finding what works for you and what you find easiest as well, so that makes it more likely that you're going to kind of build that habit of tracking it and sitting down and looking at what is it on a monthly basis, and then also accounting for all those annual payments that might come out. And having a plan makes people feel more confident and more secure. But it does take that little bit of time of going through your bank statements and really working out what that means. It'll then also help you understand how much you can save or potentially save and be realistic, because often we think, oh, well, I'll just put X amount aside. If it's not realistic, you end up dipping into it again. And that also can create, like, you feel bad.
You do.
So instead of it being a good thing, you start feeling bad about the situation. So budgeting and then being realistic, that makes you be realistic about what you can save. So look at what your outgoings are, split it into essentials, into wants, and then into what you can potentially save. So that's a really good place to start. And then that can also inform what kind of emergency fund or buffer you would like to build up. Because if that each month you need £2,000 and then you think, okay, well, I need to then build up 3 months worth of sort of expenses just in case. Now that could be used for a car that £2,500, or it could be used because you've had to be off work for a period of time. So that's just kind of a rule of thumb that people say for an emergency fund, 3 to 6 months, just in case there's gaps in employment and that type of thing. But if what your expenses are, then you can start putting a goal in your mind, right, this is actually how much I would like to get to. But without kind of doing that first bit, you don't necessarily know. So that would be like the ideal. But I also say as well that can sometimes feel like a big job for people.
Yeah, I was just thinking that.
Yeah, to get to that point and go through everything. So what I would say is start small and just start. So even if that is doing the roundup facility on your banking app, or if it's saying as soon as I get paid, I'm going to put £10 aside into a separate account, whatever that first step that is good for you, do that, and it will always build momentum of building a habit of, oh, well, I've got the savings account now. And if at ease, do it with your existing bank account. That might not be the best interest rate now, but start in a way that's comfortable for you, that you can start. So start small, start a habit, and don't kind of doing the big thing and making it feel overwhelming, would maybe mean that you don't actually go ahead and do it. So just do what's realistic for you. So that's why I say, that would be the ideal, but actually just starting is really the biggest thing.
Yeah, honestly, I think there's also, just to be completely transparent, I think there's this misunderstanding around savings as well. People think it's only a tenner. What's the point? Like, what's the point of saving a tenner? But you're so right. It's about creating that habit. It's about building momentum, because one month you'll see a tenner, and hopefully the next month or the next paycheck, if that's weekly, you can maybe put 15 aside. And then maybe even you realize like the roundup is quite fun to use actually on your mobile apps. Yeah, like you can do that. And something that's personally helped me is styling. I think other banks have it as well. They have pots. So basically, you've probably know exactly about this, but a pot is basically like you can create a, I don't know, like a little pot. It literally is what it is actually.
Yeah, it's just like a ring-fenced amount, isn't it? That's
Yeah,
separate from your everyday spending.
exactly.
Yeah.
So what I used to do is I used to put the tax, like the second I get paid from any job, I just put that tax money away, just to put it away, forget about it, name it tax, so I know I can't touch it. And then I would have other categories. And this didn't happen on day one. This happened over a whole year and a half of me learning, oh, I need marketing costs. That's an expense. I need that. Okay, let's put a very small amount of money away every single month. So at the end of the year, the following year, I have that budget in place.
Yeah.
You're absolutely right. This does not happen in the first day or the first month or the first paycheck. This is something that you just start small and you keep working towards. I think that's such a fantastic way of describing it.
Yeah, it's like decision paralysis, isn't it? You think, oh my gosh, there's so much to do. I need like 5 hours to do it, and I don't have the time to commit. And so it's just start small. If you've got 20 minutes, you take 20 minutes. What can you do in that 20 minutes? And just start and do that. And then,
Absolutely.
It'll build momentum.
100%. I think I've personally experienced it, and we just do not appreciate when we have that little bit of money and something does go wrong, then you can just go, oh, that's okay, going to be all right.
Yeah.
And I think there's definitely no shame in starting small. Everyone has to start somewhere, and even if it is that tenner, the best advice is stick it away and let it. Yeah, you're absolutely right. Build momentum, build habits, and yeah, it will move forward. And something you touched on there was like interest rates and savings and things. Is it possible to kind of explain to us what that is? Like, how would you explain what that is, what accounts to go for? Because there's so many. Like, you go onto an app and you're just like, oh my God, like, do I want a fixed rate? Do I want a variable rate? Do I want to be stuck in it? Do I want an ISA? Then you hear someone online going about index fund. Like, what's an index fund? What is all this stuff? Like, it's so confusing.
I mean, how long have we got? I don't know.
Yeah, true.
So savings, there's lots of different options. I think, as you have kind of just said about starting off with what is the purpose of the money that you're saving. So if it's an emergency fund, then generally speaking, you want an instant access savings account, because in an emergency, you don't want to be like, oh, there's a waiting period, or I'm going to be penalised, or it's an emergency and you need the money instantly. So that needs to be an instant access savings account. It's good to set it up as a separate account away from your current account. That creates that barrier of being able to just dip into it. So having a separate account for specific purposes is a good idea. Yes, generally speaking, they'd be instant access savings accounts where the interest rates might be lower than what you would just mentioned, like fixed rate savings accounts, which offer you. So instant access, normally variable rate, can go up and down, and it's lower because you can obviously get to the money sooner. Fixed rate accounts, you normally get a fixed rate of return, so you know what the interest rate is going to be, but there's normally a restriction in terms of access. So it might be 12 months. Sometimes you can get at it within that period, but for a penalty of interest and things like that. So really, that's the things where you can kind of lock it away for a period of time. So it might be, if you're saving for next year's holiday and there's a 6-month fixed rate account, whatever it might be, or a bigger purchase like a wedding, but something that you know that you're not going to need that money. And also you might use that as a way of not encouraging you not to access that money as well for something that it's not meant for. So you normally get a higher rate of interest because you're locking the money away. So there's kind of instant access and fixed rate. In terms of ISAs, which I think you mentioned, they're tax free, so you don't get charged any income tax or capital gains tax if it's an investment one. But for cash ISAs, you won't be charged income tax on any of the interest. So that's a good option, you can have up to £20,000 in, your ISA allowance is £20,000. And you can use that allowance across a number of different types of ISAs that are available. So there's cash ISAs, there's stocks and shares ISAs, there's lifetime ISAs, there's etc. So you can use that across them, but the maximum allowance is £20,000. So again, they sometimes are instant access, sometimes are fixed rates, etc. So they're good for not having to pay any tax, but there is a personal allowance on your savings anyway, which I won't kind of complicate with. So you have to interest over a certain amount before you pay tax on it anyway. So those are the kind of like main savings accounts, and they can be, like I say, cash. And for short-term goals or things that you're saving for, cash is good because it is stable. So you wouldn't want to put your emergency fund in investments that might go up and down, because you want that to be a specific amount. You want it to be a safety net. So you would keep that obviously in cash. And they say really for investing, you have to be looking to like lock your money away for like 5 years plus to ride out sort of market fluctuations. So cash savings are good for those sort of shorter term goals, like saving for your tax, and like you mentioned, putting that aside, and emergencies, etc. And then then there is investing. But before you do invest, you do need to think, have I got an emergency fund in place? So you don't really want to be going down the investment route where your money can go up and down in value until you've got that buffer of an emergency fund, that the basics really, and that foundation to your financial situation. And also thinking about, if you've got high interest debt that needs paying down as well. So if you have credit cards, you could be paying interest of sort of 20% upwards, which is huge. So by paying them down, you're paying down that interest, and getting those things under control, we would say is better than to do before you invest.
So clear your debts before you invest in savings. Is that what you're sort of saying there?
In terms of investing, for savings like emergency fund, there is a kind of debate, like, should I start an emergency fund if I've already got credit card debt? Cash, because and one way to look at it with debt versus saving is how much interest could I earn on my savings account? So let's say it was 4%, and how much interest am I paying on my credit card debt? And that could be like 20%.
Of course.
So from a purely financial perspective, you would say pay down my credit card debt because I'm saving 20% and I'm only I'm only earning 4% here. So actually financially it would make sense to pay down my debt. And that does make sense financially. However, for some people, that if they don't have any buffer, they end up just increasing the credit card debt. So actually finding a balance between the two might be a good option for somebody, but that's something to consider. But overall, financially paying down, and it's not all debt, as I say, it's high interest debt. People can have a mortgage.
Exactly.
I'm not saying pay off your mortgage before you save an emergency fund. I'm talking about, like a payday loan or a high interest credit card that you can't switch to a 0%, because that's another thing. If you do have high interest credit card debt, think about how can you switch that to something where you're paying a lower interest rate, if that's possible. You might be able to switch to 0%. It might not be available to you. There might be other debt consolidation options to bring that interest rate down as well, which might be something to consider. But that, I was just kind of giving a basic,
of course.
interest versus the debt interest to help make a decision.
I think that's such fantastic knowledge, honestly. Like, there are credit cards out there and payday loans which charge huge amounts of interest, especially on missed payments and things like that. So again, I personally believe if you have got high interest credit cards, loans, or anything like that, in my personal opinion, I'd be paying them off well before thinking about sticking money in a potentially a high risk investment. Because I think a lot of people also believe, if I'm investing money, over time I could win, like potentially big. But actually, things like cryptocurrency and stuff like that, which is coming in, and a lot of young people and a lot of construction workers I've spoken to invest into that. And I don't think there's enough knowledge, because these are just the people I'm speaking to. they're also living month by month on their credit cards. It's that for me would give me so much insecurity, because I'll be like, oh my God, like all it takes is one bad crypto day and that could plummet into nothing. And you've still got those credit cards that they'll be knocking on your door. They'll still be asking for that payment. It's such a scary place to be.
Yeah. And that's exactly it with investing. That's why we say you should pay down those high interest debts, because people don't consider that actually your investment needs to do annually over 20% a year to actually compensate for what you're paying on your credit card debt. And that is just not actually the average returns of the market. And you do have these outlier years of cryptocurrency doing amazing, but then nobody's talking about the ones where it went down significantly. And if you do have an emergency, you can't get to that easily, or you'll be selling it when you've lost money, and then that will be a worse place to be. But also these investments that like you talk about are high risk. They are very high risk, and the reason why they are so high risk is because the fluctuations are so high. So it's definitely, I would agree, you want to be getting the foundations right of emergency fund, paying down high interest debt before even thinking about those high risk, and actually having those things, those buffers, those foundations mean that you will be in a position where you can start to make a decision and go, well, do you know what, actually I'm secure financially, I've got things that I've got the foundations in place. You might be investing in a more diversified portfolio, and you could take the risk with a small portion of the money that you want, but having those foundations in place help you be able to do that and facilitate that. It's without stress. Absolutely. Without thinking, it's kind of chasing the returns to get out of the situation that you're in, rather than taking the time to plan and do that, and probably getting the proper support that is available from various sort of charities and support organisations to help you get out of the debt situation, rather than relying on volatile returns from a really high risk investment.
Absolutely. And talking about investments, something we don't really consider a lot of, and I know I don't, is that cheeky little pension pot. I haven't got one yet, and I'm like 31 years old, and I'm like stressed out about it. But it's also, I don't understand it. It's like, again, I don't know, like pension pots are so important, because you want to future plan, just like we're future planning for the micro things like next year's marketing costs, or next year's service on MOT or whatever on the vehicle, and we're creating those little pots on our styling accounts or whatever. I guess the huge thing is we need to start thinking about the future and pensions. Could you help me understand? Okay, one, what is a pension? Like, because obviously it sounds like, oh yeah, it's just money for the future, but actually what is a pension? And I think there's benefits as well to it, I guess, when you've got your own business, especially because a lot of construction workers do. Could you help me understand what that is and how that's beneficial for the future?
Yeah. So a pension is really just a tax efficient savings pot.
Okay.
If you kind of think of it like that. It's just a bit of a sort of scary word, isn't it? Pensions. And then also it feels like so far away, thinking about retirement or anything like that. But it is just a savings pot account. The difference is it's for a specific purpose, really, which is retirement, but it's really tax efficient. So when you put money into the pension, you get tax back from the government. So for example, if you put £80 in, the government makes that up to 100. So there, like if you're a basic rate taxpayer, and then if you're a higher rate taxpayer, you get 40% tax relief. So you're getting back the tax that you paid. So it's really tax efficient. It's sort of free. It's like free money, isn't it? You pay the tax, but you're getting it back. So you're actually benefiting from the full amount. So it's really tax efficient from that perspective. On any investments that you make, if there's any income or growth within the pension, there's no tax on that income and growth. So it's really tax efficient from that point of view. And then in the future, when you take it out, you can get 25% tax free out, and then you can draw an income. So the tax benefits are huge. If you are employed, not self-employed, then your employer will also put money into the pension. Now, if you chose not to be in the pension, they don't then just give you the money that they would have put in the pension.
Mm-hmm.
So you're kind of losing out on extra money from your employer if you don't stay in the pension. You have to opt out, but it's like, it's a good place to be. It's extra money from your employer that's going towards your retirement. I think because it's so far away, people kind of separate it in their head.
Absolutely.
And they think, oh, like, it's not real money, it's not my money, because I can't access it until I'm 55, which is going up to 57. But it is your money, and you can always keep it. And even if you left your employer and went to a different one, that pension is yours. So it is just savings for the long term. But I do think what puts people off is that they can't access it. But obviously that's all part of the process. Like, you also need that barrier so that you can save it for your retirement. So yeah, it's a fund for your retirement. It's really, really tax efficient because you get tax relief back that you would have paid income tax, loads of tax relief whilst you're in it, and then 25% tax-free cash when you draw out of it. And the state pension, which is obviously what the government gives, is most people aren't going to get it until the late 60s, and a lot of people might want to retire before that, especially maybe if you're in a physical role. You might not want to be working until that age, and the amount that you get, it isn't the equivalent of what they say is appropriate for like living standards or the average amount that you need for a good standard of living. So you really want to be contributing something yourself to save for the future. Again, start small. There's pensions out there as a self-employed individual, and obviously as for employers, you can start really small, £10 a month, whatever it may be.
I didn't know that.
You can, there's loads out there that you can start at a really small amount, get that habit going, see it building. They do really great now as well because it is so far away and can feel a bit separated. You've got apps that you can then monitor it on. And that's also what people don't realise, is it is an investment. So when people are investing in other things and crypto, your pension is actually an investment too, and it will grow. And so you can get then hopefully that kind of buzz of seeing, I put this money in and it's invested and it's grown to XYZ in a year. And you can see that visually, which I think a lot more providers are helping people do, which I think makes it feel more relevant and relatable to today.
I guess it also makes it feel real, because I think with a lot of pension schemes, you get, I could be wrong on this, but I think you get like an annual statement that comes through, and then you can see what you've got. But if there's a digital version where you can actually see the money grow with compound interest or whatnot, then it feels real and it feels exciting. I guess something that's another, I've just said it now, so I'm going to ask the question. Compound interest, that's a really interesting topic as well. I'm sorry, by the way, I've proper dropped you in it today. Now, we have gone from budgeting to savings. I'm trying to cram as much knowledge out of you.
Savings, investing, retirement, covering it all.
I appreciate you just kind of like coming out of as much information as you can, so thank you. But I think, compound interest is, again, something people don't really understand. Is there a possibility you could kind of briefly, again, explain what it is and how it's so beneficial?
I mean, it's basically just growth on growth. So it's like if you had £100 and it grew by 5%, and you then had 105, and then that grew again by 5%, the 5% will be on the 105. Not the 100. So it's like, it's growth on growth. So that £5 of growth didn't cost you for anything. It just grew. And so then when you get that growth again, it grows on this larger amount. And over time, that compounding effect of the growth on the growth, as well as your investment, makes a huge difference. So that's as simple as it is, really. It's just growth on growth. So you're not just, so it's not like £100 and every time you get 5%, it's only on the initial £100. It's not. As that grows, the amount that the growth is on grows, if that makes sense.
Actually, you know what? I think that's the best description of compound interest anyone has ever given. Is literally 3 words: growth on growth. And I just thought to myself, wow, I've read like books on this stuff, and you think nobody has explained it as easy as that. And it is quite literally as easy as that. It is, That is such a great way to explain it.
In there. If you take money out, then when you get the growth, it's just going to be on a lesser amount. So it hopefully encourages and motivates, like, just leave it in there and let it all grow. And that's why with investing, we say, you know, have a 5+ year time horizon to allow that to happen, the growth on growth and the compounding, and for it to gain momentum. Because if you keep taking money out, you just don't get the same returns. And so, and also to manage the fluctuations. But yeah, that's why it's best to, if you're investing, go for the longer term.
Absolutely. And I guess when you're investing, something we touched on with crypto is this is quite a high risk category to invest in, because there's also a low risk, a medium risk, and then the high risk. What would you say a pension? Would you say a pension is like a low risk, and then a crypto is a high risk, and then where would we sit in the middle of that? Would that just be an ISA account or something, or is that, I guess, a low risk?
So what I'd say that a pension is a product and an ISA is a product.
Okay.
Whereas crypto is an investment. Okay. So an ISA and a pension can have investments inside them, which could be index funds, which you, I think, mentioned, or it could be actively managed funds. It could be individual stocks, a share in Apple or Amazon or whatever it may be as well. And that's kind of the comparable to the crypto. It's the investment element. So a pension or an ISA as a product are kind of neither high-low sort of risk. From an investment perspective, it depends what you put in them. So you could have a pension that's 100% invested in like equities that are global. That would be higher risk than a pension that's invested 100% in cash, which is not something that you would normally do. But so it's the actual kind of asset class, the investment that's creating the risk. So cash is super low risk because it stays the same value regardless. People could say the risk to that is like inflation, because if your interest rate's below the rate of inflation, then spending power as an investment, it's low risk because it's going to be the same amount. And then you've got like fixed interest bonds, which have a fixed rate of return, and they're a little bit more risky. And then you start getting into equities, which is buying shares in companies, and they're higher risk. And then even within that, there's varying levels of risk, because you could, within buying shares in companies, you might buy an index fund that's really diversified, that just tracks the index. And that would be lower risk than if you bought a 100% global equity fund where it's actively managed and picking stocks. And then even higher than that risk is like picking individual stocks, and then your portfolio is less diversified. So those are where the investment, and it's really about, so there's loads of options. What I would say is, when you get a pension, when you get a stocks and shares ISA, the provider, if it's your employer or if it's one that you're doing yourself, will provide that kind of guidance throughout their journey. So there's normally like a default fund, which is like a medium risk probably fund. And they can take into account how long you're investing for and stuff, and make sort of suggestions of options that you could select at varying lists. So don't let that, because it sounds more complicated when I'm explaining it, but there are different options basically to suit different risks. And when you apply those options with their provider, they do give a lot of information to help you decide where you want to sit on that kind of risk spectrum. So pensions and ISAs are more products rather than, and the investments that you put in them is where the risk sits.
So I don't know if this is like, I've read this in a book, I can't remember which book it was, but I sort of learned, and again, you can correct me if I'm wrong, and please do. When you're younger, you want to kind of go towards the medium to high risk, but the older you get, you want to kind of go to medium to low to then low. Is that sort of the right rule of thumb on that?
Yeah, often, because it's about time horizon. So it's like, how long are you leaving the money invested for? So if you're leaving it invested for 30 years, then you could probably take a higher level of risk, because you're not going to access it. So you can just, like, if it goes up and down for all of those, as you get near to that point, it doesn't make any difference because you're not touching it. And that's the thing with investing, you don't want to be touching it, because it will fluctuate. If there's an election, if a company does something, there's different things in the markets and that will happen economically that will impact the investment value.
Mm-hmm.
But ultimately, the trend is go up over time. So the longer you've got to ride it out.
Gotcha.
As you get nearer to when you want the money, then you want to take a little bit less risk because you want to make sure that, if I want to take my money out next year, do I want to risk that this year it could go down 20% for some reason that I'm not aware of? You probably want to minimize that potential.
Mm-hmm.
So then you reduce the risk. So the lower risk, the smaller the fluctuations in value. The higher the risk, the higher the potential fluctuations in value. So that's why as you get near to when you want to access it, you probably would reduce the risk. But it all is based on how long you've got to keep it invested.
That makes complete sense. And I think something that really helped me because I've come from a background where money was just not spoken about. It just wasn't spoken about. And I found I had to go search for my own resources into learning about these small little nuggets like the ones you've shared with us today. And I don't know if you've heard of a book called Rich Dad, Poor Dad. I don't know if you've heard of it.
Yeah.
I think it's such an interesting read because the information in the book is good, but it's such an easy read. It helped me understand the basics. And then I kind of moved on to another book called How to Own the World. I don't know the author, but it was absolutely fantastic. Like from reading Rich Dad, Poor Dad, which is, I don't know, it's such an easy read. To then going on to reading like How to Own the World, which is a bit more of a complex read. It was really nice to understand that transition because the wording and things like that, you understand it in Rich Dad Poor Dad, and then when you get to How to Own the World, you're like, oh, I know what he's talking about. So I think a bit of advice I think I could give to anyone who's interested in this topic is don't go read the most complex books out there which are going into depth on everything, because it won't make sense and it's actually probably going to dishearten you more. Start with like maybe reading a blog or reading an article and then going on to like maybe Rich Dad Poor Dad, like the journey I followed, and then going to like a little bit more complex book, and then you can start building that awareness. Have you got any tips for our listeners who they're really interested in this topic? They don't know where to start. Obviously, financially, they can start with just that small £10 in a savings account. But what about when they want to do their own research? I know you mentioned a few charities who help in with debt, but what about investing in the future? What could they do to their first step?
I guess it depends which stage that they're at, obviously, where they would obtain the information from. If they want to learn about investing, there's loads of providers out there that really do give a lot of education on their sites. So maybe one place to start, there's comparison sites for sort of different types of investments, stocks and shares, ISAs, pensions. Like you can go on Money Supermarket, or there's one called Boring Money, and that's it's like an intuitive platform that, you can kind of pick what types of features you like, or like if you want it to have an app and all of those things, and they rate them, and you can then explore maybe what that provider offers, because there's a lot of education on there. And they do intentionally make it as simple as possible for people to be able to get started. I'd probably say like a warning around where you get your information. So those would be reputable sources. They're regulated by the FCA providers. They have to communicate in a certain way. And with Consumer Duty, things are getting clearer in terms of that. There's obviously social media influencers that are also out there that are educating around finances, some of which are hugely credible, have a lot of qualifications. So just a word of warning on that is that just make sure that who you are following is credible and is providing good information, because there are some really good ones out there as well. But if you are looking to social media and getting ideas off social media, make sure you know who it is that you get learning that information from, and still do your own research, because if they're only short videos on, so it's hard to get the full grasp of what the topic is. So I would say, maybe have a look at one of these comparison sites, pick a provider, go on their website and follow the journey on there. There'll be loads of videos and education bits on there around investing. A kind of unbiased place for all information around finances is called Money Helper.
Okay.
So that is actually a government-backed website that has literally everything around money. You can even do a WhatsApp chat. You can do phone calls around pensions. You can, if you're over 50, I think there's like a free pension call, and they give guidance. They don't give advice, but they will provide you with this information as well.
Mm-hmm.
But it's really easy to consume, like, you know, really understandable language. Great place. It's a great place for really anything to do with money, not just investing.
Mm-hmm.
So you'll cover everything to do with emergency fund, all of the things that we've talked about pensions. So it's a really good one-stop shop as well for, like, you know, it'd be mortgages, anything to do with money. And it will also have on there, it has like a debt advice locator. So if people are struggling and they are looking for support, then you can put in your bit of information and they'll say what, you know, what would be the best organisation for you to get in touch with. But that's probably, yeah, a good place to start for everything. In terms of getting that education piece.
So there's two companies you said there. Is it the Boring Money?
Boring Money has a good comparison site for stocks and shares, ISAs, pensions, etc. if you're looking for providers. And Money Helper is just a great website for everything finance, and that the information that they provide is going to be accurate, credible, and there's ways to contact them as well. So it serves different preferences for people of how they like to learn.
That's fantastic. I'll make sure to put those in the bio so people can click on the links. Just to kind of round up, because this has been such an informative conversation. I know I'm going to personally be listening back to it because you've given some golden nuggets today. You've shared your knowledge and that's just phenomenal. So thank you so much. But before we end, I kind of wanted to touch on the mental health side of the financial battles people do go through, and kind of touch on how hard it is for people to be in that position where they feel so stuck and they feel so trapped in this vicious cycle. I'd love to understand from your background and the customers you work with, how beneficial it is to have this education.
Yeah, I think there's a massive link between money and mental health. I think, you know, there's loads of research to suggest it's like the top issue that creates stress and anxiety for people, which is understandable, especially in the current climate as well.
Absolutely.
And there's been loads of things like Samaritans and Lighthouse Charity coming out with their statistics around how many calls they have that are finance related. So it's a huge issue for people, and I think it's kind of like interlinked in a sense that if you also have mental health concerns, it can make it more difficult for you to manage money, because, you know, like what we've talked about today, there's so much to learn if you're wanting to, and it can feel overwhelming, and then it can mean people don't take action. It creates more stress for them. Things are harder to manage if you are having mental health challenges. And then obviously, yeah, if you're having financial challenges, that can obviously cause concern with mental health. There's so many resources out there. Samaritans, as I've just mentioned, Lighthouse Charity for construction workers, there's lots of different ones, and many organisations have mental health first aiders. And one of the big reasons why with Money First Aid is to help with that challenge around how it impacts people's mental health and their lives and that context. We're trying to kind of bring kind of empathy, human approach to the situation, not just be that everybody's like the numbers. So that person's in debt, or they've got this amount, or they're not managing this. It's actually what's going on for that individual and the context of their circumstances that's creating this as well, because some things are outside of people's control, like, as we've talked about, different work patterns, etc. So, you know, I would encourage people who are struggling to talk to people, but then I'd also encourage employers, people in the communities, or, you know, families, to check in with people about finances, or just generally check in with people and offer support where possible in terms of signposting to the places that are available.
Yeah, absolutely. And I think you've touched on so many really important topics there in regards to mental health. And I guess it's really nice to hear that there are charities out there like Samaritans and Lighthouse Charity, and there's actually a handful more that I've put on a couple of my blogs and stuff. And it's so important that people know that when you are struggling, it's okay to seek help. There's no negative stigma around seeking help, and if there is, there shouldn't be. If you're struggling, reach out to these charities. They're there to support you. They're not there to judge you. No one's gonna put you down for being in a tough space. Life happens. Like, life absolutely happens, and there are support networks out there which, if you're listening to this and kind of going, oh my god, this really does relate to me, to pick up the phone or go onto their website, because there's no shame in asking for help. And there's just zero shame. There's no judgment. If you need it, go get the help. I think that's just absolutely vital.
Yeah, definitely.
But Rachel, I just want to say, firstly, thank you so much for allowing me to cram in so many questions and pick your brains on so many different aspects of money. And just thank you so much for sharing your knowledge and taking time out of your busy schedule to be here and share your knowledge with our listeners. And hopefully it reaches the right people and it just builds awareness and education around something that doesn't need to be such a difficult conversation. So thank you for having such an easy conversation as well.
Thank you for having me.
No, honestly, absolutely fantastic. But thank you so much. If you've enjoyed this episode, don't forget to like, share and subscribe to the channel. Honestly, the more people we reach, the more support we can offer. And don't forget, Onward Shift isn't just a podcast. We've got a number of resources on our website, so please don't forget to check out www.onwardshift.com, where you'll find counsellors, keynote speakers, coaches, blogs, and so much more. Until next time, don't forget to keep having these important conversations.